Well, the prospectus for the $7 billion float of the QR National Rail business has been out for a week now, and its brokers and management are spruiking the float to retail and institutional investors alike. So how do the prospectus and the spruiking stack up? I asked an independent number cruncher and fund manager, Mike Mangan from 2MG Asset Management. Well, Mike, as a fund manager, will you be investing in QR National?
No, we won't, Alan.
So why not?
It's not because of the business or the management. I think they're fine. The problem I've got is the pricing range that's been established in the prospectus and the process that's been established. Now, admittedly, the process is one that's been used for a long time, but I think it's inherently unfair to retail investors. They basically have to write a blank cheque to the promoters, and then they have to wait on the institutions to set the price. And given that the pricing range is quite high, I'm uncomfortable with the way that that whole process is constructed.
Well, as you say, it's been around for quite a while. Do you think it should be stopped?
I think there's an ethical problem there. And I'll explain it this way. If you went to buy a house and the real estate agent said to you, look, there's a lot of interest in this house, but give me a blank cheque and I'll look after your interests, you'd laugh and you'd walk away. You wouldn't do it. And that's what the process is for this float, as well as other floats. And it really came into stark contrast with the Myer IPO, because this is exactly the same MO as Myer. And what you found is that the bidding tension, as they call it in the industry, resulted in a silly price. And when the punters realised it was a silly price, there was a panic for the exits, and that's why Myer fell from $4 to $3.
But should ASIC ban it, though, do you think?
I think so. I think it's inherently unfair. I mean, I'll give you another example. If you did this, if you put the shoe on the other foot, if you said to the institutions, give me a blank cheque, and retail investors will set the price, the institutions would do one of two things. They'd either laugh at you or they'd show you the door. I think there's an element of taking advantage of unsophisticated investors by asking them for a blank cheque and waiting for the institutions to set the price.
Well, just looking at the price range that has been mentioned now, what sort of valuation does that put on QR National, and how does that compare with other companies in the same industry?
I guess this is the other element of my issue. I won't even talk about the high end of the range. I think it's dreamland. But at the low end, $2.50, it's still more expensive than almost any other comparable stock that I look at. For example, Asciano, which I can't justify buying, is cheaper. You can buy a range of very good quality mining contractors, all with leverage to the China story, and they're on much lower multiples. For example, Worley's on 17 and UGL's on 14 times, whereas at the low end that the promoters are asking for Queensland Rail, you're looking at about 21 times. So I think the pricing is way too high. And if you want some commodity price risk, you can buy a BHP or a Rio for 9 to 11 times earnings. So I just think on the pricing structure that they've presented in the prospectus, it's not a good deal.
So we're looking at the deal and the way the process is structured. Do you think the float might actually fail, or will it go ahead and the people who buy into it end up losing money?
Look, the float's not going to fail. They'll get it away at a price. And if my view is correct, then they'll probably adjust the pricing range. Now, I'm not saying that that's going to happen, but I think there is a real risk that you end up with a Myer situation, where at the end of the day, for whatever reason, the institutions price it at a higher than justified price, and when the punters work that out, it's a rush for the exits.
But why would the institutions do that? I mean, they're not stupid, are they?
It's a very clever process, is that it's creating, as I said, bidding tension. And right now there's a roadshow going around to retail investors, and what they're hoping is to create a huge amount of demand from retail investors, which will squeeze the institutions and squeeze them into bidding a higher price than perhaps they think is fair value. Now, you will have some institutions, particularly the index funds, who will buy it regardless of price. It's what I call the ultimate dumb money, is that they're not even interested in value. What they're interested in is having an index weight. And those guys are becoming a larger and larger component of the market. And there's an element of that in Myer, and I think there'll certainly be an element of that in Queensland Rail. You'll have other institutions who won't like the value, but because of their size, they believe that they need to have a position, even, albeit an underweight position.
I suppose against everything you've been saying is the fact that investments like this don't come along every day. I mean, it's a well-run business. It's got a good, strong share of the market, and it's exposed to the commodity industries.
Yep, no, I agree with all that. But what I'm saying is that there are other comparables already existing on the market, and they've been around for a lot longer in terms of share market surveillance. And investors are aware of these companies. They understand the management and the philosophy of these companies. They are trading on lower multiples than what Queensland Rail is being billed at in the prospectus.
Thanks very much for joining us, Mike.
Thanks, Alan.